Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host. I'm Sandy, your guest host from Keller Williams Legacies, here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamoan here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode. Sandy, it seems like Toronto's long-standing dominance in the housing market is facing a major shakeup this year. Traditionally, Toronto has been the leader, especially in multifamily housing starts, but the numbers from the Canada Mortgage and Housing Corporation have shown a big change in 2025.
That's right, Steve. For the first time in a long while, Toronto isn't leading the pack. Calgary has taken the top spot with 18,632 housing starts, followed closely by Vancouver and Montreal. Toronto, surprisingly, is in fourth place with only 16,451 starts. It's quite a shift from what we're used to seeing.
The year-to-date percentage change is quite telling as well. Montreal's up by 47%, and Ottawa-Gatineau is up by 32%. Even Edmonton and Calgary have seen impressive increases. Meanwhile, Toronto's numbers have dropped by 47%.
It's certainly a surprising downturn for Toronto, especially given its usual dominance in multi-unit housing starts. Typically, these account for about 90% of Toronto's total starts. This year, they've dipped to 87%, and the overall starts are down nearly half from last year.
The demand for new condominiums in Toronto seems to have really dried up, which is a bit alarming. Meanwhile, cities like Calgary and Montreal are seeing significant increases in multi-unit starts, up 30% and 49% respectively. It's interesting to see how these dynamics are playing out across different regions.
Absolutely, Steve. And it's not just the housing starts themselves, but also the broader economic conditions that are influencing these numbers. The federal government has introduced initiatives like the Build Canada Homes to address the need for more housing. They're also pushing for modular construction to increase supply.
Yes, and provinces are also stepping in to help. Ontario's Bill 17 aims to streamline processes and reduce costs for builders, which could help stimulate new projects. But in the short term, Toronto's market is facing challenges, especially with high prices affecting affordability.
The Bank of Canada has lowered interest rates to help with affordability, but the economic headwinds, particularly those stemming from international trade issues, are still a concern. Ontario's economy, with its reliance on sectors like steel and auto, is quite sensitive to these tariffs.
And while these tariffs are impacting Ontario, Alberta seems to be benefiting from free-flowing energy products across the border. Their housing market is reflecting that strength with a 21% increase in total unit starts year to date.
It's a complex landscape, and while Toronto is struggling with demand issues, other cities are thriving. It'll be important to keep an eye on how these trends continue to develop, especially with government interventions aimed at boosting the housing supply.
Sandy, it seems like the recent comments from Federal Housing Minister Gregor Robertson are stirring up quite a conversation about housing affordability in Canada. Robertson mentioned that the average price of housing needs to fall to restore affordability. What do you make of this statement?
Well, Steve, it's definitely a bold statement from Minister Robertson. He's highlighting a significant issue that many Canadians are facing. The average home price has skyrocketed over the years, making it increasingly difficult for first-time buyers to enter the market. Robertson's call to bring down average prices is certainly noteworthy, but it's not without its challenges.
Absolutely, Sandy. Robertson's focus is on average prices rather than individual home values, which is an interesting distinction. It's about making the market more accessible overall, not necessarily devaluing people's existing properties. However, the Conservative MP Aaron Gunn did challenge him on this, reminding Robertson of his previous stance where he said home prices didn't need to fall.
Right, Steve. It seems Robertson has shifted his approach, possibly in response to the ongoing housing crisis. He emphasized the need for more non-market housing to help bring down the average cost. This could mean more government intervention and support for affordable housing projects, which might be necessary given the current state of the market.
And it's not just the minister's comments that are drawing attention. Organizations like Generation Squeeze have been advocating for generational fairness in government policy. They reported that the time needed to save for a down payment has increased dramatically over the years. In some areas like the Greater Toronto Area and Metro Vancouver, it's become nearly impossible for young people to save enough for a down payment.
That's a critical point, Steve. The report by Generation Squeeze highlighted that, nationally, the average home price would need to fall by a significant amount, or full-time earnings would need to double for typical young people to afford a mortgage. It's a stark reality that many are facing, and it underscores the urgency of addressing housing affordability.
Exactly, Sandy. Minister Robertson did spend a lot of time defending the previous Liberal government's housing record during his committee appearance. He pointed out that housing has been becoming less affordable for decades, and it's a complex issue influenced by multiple factors, including population growth and immigration policies.
And that's the crux of it, Steve. While Robertson is advocating for solutions like the Build Canada Homes Agency to create more non-market housing, it's clear that a multifaceted approach is needed. The proposed Bill C4, which offers tax relief for first-time homebuyers, is one piece of the puzzle. But there's much more to be done to truly restore affordability.
Sandy, let's dive into the recent inflation data coming out of Canada. The annual rate of inflation has jumped to 2.4% as of last month, which is higher than what economists were expecting. This increase seems to be driven by rising food prices and a slower decline in fuel prices.
That's right, Steve. It's interesting to note that this inflation uptick might affect the Bank of Canada's decision on whether or not to cut interest rates in their upcoming meeting. With the consumer price index rising more than anticipated, the central bank might be reconsidering its stance on rate cuts.
Exactly. Doug Porter, the chief economist at the Bank of Montreal, pointed out that this increase in inflation could make the Bank of Canada's decision more complicated. He mentioned that markets were almost certain of a rate cut after Governor Macklem's previous remarks and a recent Soft Business Outlook survey. But now, with this inflation data, the decision isn't as clear-cut.
Porter did say that while they were leaning towards a rate cut, they weren't convinced it would happen in October. This recent inflation data might just reinforce their position to hold off on any cuts for now. It's a delicate balance, especially with the economic uncertainties we're facing.
Michael Davenport from Oxford Economics also chimed in, suggesting that while underlying inflation pressures are still contained, the overall economic struggle and labor market slack might still push for a rate cut. He predicts a possible 25 basis point cut next week, but believes it could be the last one for a while.
It seems like there's a lot of mixed signals, Steve. The Bank of Canada is scheduled to meet next Wednesday, and it'll be interesting to see how they navigate these economic waters. With property taxes and rent costs rising, and homeowners' replacement costs slipping, there's a lot for them to consider.
Absolutely, Sandy. The final decision of the year is set for December 10th, and it'll be crucial for the central bank to weigh all these factors carefully. As always, it's important for our listeners to stay informed as these decisions can have significant impacts on the housing and mortgage markets. Sandy, let's shift our focus to the Canadian dollar and its recent performance. The loonie has been holding steady near a 6-month low against the US dollar, trading at 1.4025 per US dollar or 71.30 US cents. This comes as oil prices have fallen, and the Bank of Canada's quarterly business and consumer surveys have supported expectations for another interest rate cut this month. What are your thoughts on this situation?
Well, Steve, it's certainly an interesting time for the loonie. The fact that it's near a 6-month low highlights some of the economic challenges Canada is facing. The oil price drop is a key factor here, as it tends to have a significant impact on the Canadian economy. Additionally, the Bank of Canada's surveys showing only marginal improvements in business conditions are reinforcing the possibility of a rate cut.
That's right, Sandy. According to the Bank of Canada's survey for the third quarter, Canadian firms are seeing slightly better conditions than earlier in the year. However, they're still hesitant to boost investments or hiring due due to the dampening effect of U.S. tariffs. This cautious approach from businesses is reflected in the Business Outlook indicator, which rose to -2.28 from -2.40 in the previous quarter.
Exactly, Steve. Andrew Grantham, a senior economist at CIBC Capital Markets, noted that the surveys continue to paint a downbeat picture of the economy, despite some marginal improvement. He emphasized that inflation expectations remain relatively contained, which further supports the likelihood of a 25 basis point rate cut from the Bank of Canada next week.
And with the Consumer Price Index report for September expected to show an increase in inflation to an annual rate of 2.3% from 1.9% in August. Investors are seeing a 77% chance of a rate cut at the Bank of Canada's October 29th policy decision. This would follow last month's rate cut to a 3-year low of 2.50%.
It seems the central bank is navigating a complex landscape, Steve. While the possibility of a rate cut is on the table, the underlying economic conditions, such as the oil price and bond yields, are also influencing their decision-making. The 10-year bond yield has dropped to 3.056%, its lowest since April 8th, reflecting some of these economic pressures.
Absolutely, Sandy. With oil prices trading 1% lower at $56.97 US dollars a barrel, there's concern about a supply glut, which could further impact the Canadian economy. As always, it's crucial for our listeners to stay informed about these developments, as they can have significant implications for the housing and mortgage markets.
Moving on to some exciting developments in the mortgage tech space, Maple Financial has received a strategic equity investment from Nesto Group. This partnership is set to advance mortgage technology and alternative lending across Canada. Steve, what can you tell us about this collaboration?
Well, Sandy, this is indeed a significant move in the mortgage industry. Maple Financial, known for its alternative mortgage solutions, is teaming up with Nesto Group and its subsidiary CMLS. This partnership combines Maple's broker relationship management underwriting with Nesto's digital platform and CMLS's national reach. The goal is to transform alternative lending for brokers and borrowers across the country.
Andrew Gilmore, the Senior Vice President of Residential at CMLS, mentioned that this investment reflects a broader industry shift. Canadians are increasingly turning to the broker channel for access to a wider range of lenders and competitive rates. This partnership seems to be addressing that trend by enhancing the options available to brokers and borrowers.
That's right, Sandy. Daniel Webster, the president of Maple Financial, described the partnership as uniting two of Canada's most innovative mortgage organizations. By leveraging Nesto's digital platform and CMLS's lending and advisory capabilities, Maple aims to expand its product offerings and improve market speed. This collaboration is about delivering more choice and transparency to brokers, borrowers, and institutional partners.
It's interesting to see how Maple Financial is positioning itself to cater to borrowers who may not qualify under conventional lending criteria. With the Royal Bank of Canada projecting a slowdown in affordability gains in the housing market, this partnership could provide much-needed flexible solutions for those borrowers.
Exactly, Sandy. Nesto Group, which administers over $73 billion in residential and commercial mortgages, is pushing forward to build Canada's mortgage ecosystem of the future. With innovations in digital technology and expanded access to mortgage solutions, this partnership is a step towards streamlining the lending process.
And with CMLS providing commercial and residential mortgage lending and servicing, this partnership is set to enhance both institutional and individual client support. Their AVEO suite of residential mortgage products already services billions in mortgages, making CMLS a key player in this collaboration.
Absolutely, Sandy. For Maple, this investment offers capital backing and access to advanced technology and servicing capabilities. It's about driving innovation in alternative lending while maintaining a personalized approach to broker partnerships. This is a promising development for the industry.
Indeed, Steve, it's clear that Maple Financial, Nesto Group, and CMLS are paving the way for a more tech-driven and accessible mortgage market in Canada. We'll be keeping an eye on how this partnership develops and what it means for the future of mortgage lending in the country.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.